The Fed has been silently, though publicly, dealing with a crisis. Liquidity is drying up, and the Fed is trying to meet the demand of the market. Their intention is to pump $75 billion of liquidity into the markets every single day into October to hopefully resolve this issue. If that doesn't resolve it, they can simply continue on a daily basis and potentially find new avenues to try and make up for the weakness taking place right now. At this time, it's obviously worrisome, but if the Fed prints enough money, it can be temporarily covered up at the expense of the value of the currency. You came here for the truth, so let me unveil that for you. Today we are going to continue our conversation about the Federal Reserve. We're talking about the repo situation, liquidity issues, everything that's happening on the inside. There's a lot of dissent happening, and this is important to follow it all. I'm going to bring it to you as quickly and concisely as possible. Let's get into it right away. One of the major factors here for the concerns globally has been the China-US trade issue that has led to a lot of the problems that the media is willing to touch on right now. Chinese trade negotiators cancel US farm visit, cut trip short. Now this made the stock market come down. Once again, they're worried that a deal isn't taking place, even though all we need is a tweet or two to suggest that things are going well, even with no evidence, even with nothing put on paper. As long as some information is out there saying things are going good, it doesn't matter that in fact everything's actually falling apart. All of the real data that we have, the little scraps, are pointing to the fact that things have gotten worse from last year to this year. Of course, both sides want to do a deal. They want to be buying and selling, importing and exporting. But the bigger issue here has nothing to do with the agriculture and every little thing that we are hearing in the sound bites in the media. It goes way beyond that. Goldman Sachs says the market is about to get wild in October. I'm not sure if that's the case. A lot of people have been pointing to October, saying this is going to be a month full of turmoil. As far as I'm concerned, what we have seen going on with the Federal Reserve, liquidity issues, as well as the China-US trade tensions could come to a head right now and into October. We'll see. I wanted to show you this because when you look at the Chinese currency, particularly as it was hitting that 7 to the US dollar mark, there was this huge freak out when it crossed over the line. And now look at it. You are seeing it at 7.1. Apparently, it was all psychological because now where it's at is much worse than where it was when it crossed that line, but nobody seems to really be freaking out now. The market always overreacts to any news. What is the significance of 7 versus 7.1? Of course, nothing. But there is a psychological aspect behind any part of the financial system. Okay, to get into the Federal Reserve issues here, I showed you this in my previous video. Just wanted to make it very clear for those who aren't aware. The gray area is the permanent OMO, open market operations, for balance sheet growth via secondary market. According to Goldman Sachs, the Federal Reserve is going to engage in a stealth QE4 as of November 2019. There are serious problems right now in the financial system. Goldman Sachs is aware, the Federal Reserve is aware. This information is apparent to anybody that's paying attention. Now we go beyond that. In yesterday's video, I showed you the repo operations, which went into the fact that they are injecting $75 billion of liquidity into the system. This is the page that you can see for yourself if you want to track all of this. I gave you that in the previous video, documented, show you where to get it. Then we go beyond that. From the New York Fed's website, you can actually see the timeline, the schedule in which they are going to be printing money over the next few weeks. Schedule of overnight and term repurchase agreement operations. Take a look at this. Monday, starting from September 23rd, $75 billion. And then we go on to the 24th, at least $75 billion, 25th, 26th, all the way down, all the way to October the 10th. at least $75 billion. And even these 14-day term operations. This right here shows you that they are willing to go all the way, whatever is necessary to keep this market liquid. This is a lot of money that is being put into the market. It shows you the real weakness that is there and the fact that without the Federal Reserve, this system would collapse. Now this is connected in with it, just wanted to read you the top portion. Banks are just about to start their usual pattern of cutting back on providing liquidity to close books and meet regulatory requirements. And next week, there's another round of treasury auctions that could leave the market net short of another $45 billion in cash. That may explain why stress is showing up in bill sales and currency markets even after the Federal Reserve conducted 3 overnight repurchase agreements, with the 4th to come on Friday to ease a liquidity shortage. In plain English, the Federal Reserve has been intervening and it's still a problem. They are pointing to this as the reason, but of course, if it continues to persist, then we have a much bigger issue. Now, we always say the Fed did this, the Fed said that, but really when you break it down, there are a bunch of people that make up the FOMC. There are more than one decision maker. Jerome Powell might be the chair, but there are more people voting on the actions. James Bullard, president and CEO, the Federal Reserve Bank of St. Louis, had some interesting things to say. First of all, he wanted to reduce the Fed funds rate by 50 basis points. 25 basis points or 0.25% wasn't enough for him. He wanted 50 basis points. And he's talking about a slowdown. He's seeing real headwinds approaching and they need to reduce interest rates in order to fix it. I've got a problem with that and I wanted to mention something further. He acknowledged the problem, as far as I'm concerned, accurately. This is according to him. The U.S. manufacturing sector already appears in recession, and overall economic growth is expected to slow in the near horizon. So the Federal Reserve, more specifically the president of the St. Louis Fed, has come out and actually suggested that the U.S. has a manufacturing recession. When you look at the data, there's no way to deny it. It's contracting left, right, and center. Manufacturing is so important. It is a bellwether of the health of the economy, even though it has shrunk significantly from many decades ago. There's something else here, though. I'll start by reading this quote. Additional monetary stimulus is not needed for an economy where labor markets are already tight and risks further inflating the prices of risky assets and encouraging households and firms to take on too much leverage. Guess who it was? It was the head of the Boston Fed, Rosengren. While risks clearly exist related to trade and geopolitical concerns, lowering rates to address uncertainty is not costless. Reducing interest rate has a cost, and I'm so happy to see somebody out there actually addressing it. What we are seeing right now with the liquidity crisis is because the Federal Reserve is trying to take down interest rates to an unnatural level. They have to intervene in the markets regularly in order to push it down far enough. As they bring that rate down further and further, the problems will of course expand. Right now, what they're doing by reducing interest rates is not going to fix the problems that are present. Typically, what would happen is that when you see the market getting too hot, you increase interest rates. When the economy is revving up a little too high, you increase interest rates, effectively putting the brakes on, nice and gently. That's the point. However, this time around, they didn't even do that. They could only get interest rates up to a level that is still considered to be historically extremely low. Now they want to bring them right back down to the floor. Once that happens, what are they going to do with their balance sheet? Well, last time around, the Federal Reserve had about $4.5 trillion worth. Their balance sheet was made up of all kinds of garbage. And of course, we see that they want to do the same thing next time around. There's no denying that. But you even have people in the Federal Reserve that are willing to point out the risks in doing such activities. Of course, there's no denying what we see in this model happens to be the New York Fed recession probability. The risks are mounting. This chart should be convincing to anybody that once it gets to this level, we've simply gone too far. It cannot be restored. It cannot be reversed. This doesn't trigger a recession, but it certainly tells you that we've come very far. What's interesting about all of this is that you have Jerome Powell that's trying to put out the fires. People are asking, what's happening with this liquidity crisis? Is it something that we should be worried about? And of course, Powell, the mainstream media, and everyone else, they're out there to tell you that everything is just fine. The last time this happened was during the financial crisis, and as far as I'm concerned, without the Federal Reserve injecting money into this system, it would fall flat on its face. Now, looking over to the ECB, their money printing scam is heavily focused on Spain and Italy. And if you've read the original The Money GPS, you would know I pointed out specifically Spain and Italy would be ones that you definitely need to keep your eye on because the cracks had already opened up for these two countries. They are very weak, and as a result, the ECB has had to step in. Initially, we had the EFSF, the ESM. There's all these financial alchemy that they have created in order to, quote, restructure the debt and so on. This doesn't fix anything, and ultimately, it points to the same problems all other central banks have to deal with, and there is no way to restore it. That's all for this video. If you found it informative, hit the thumbs up button. If you want to build a business, make money, learn about passive income, check it out at the AmazonGPS.com. It's a free course for everybody to learn. I assure you this will be the biggest Amazon course on the internet, and it's absolutely free. If you want the financial education that is not taught to you in school, these two books have everything that you need. The foundation, history, the asset classes, everything is in the link in the description. If you want the audiobook, that's available at themoneygps.com. Hang on, hold on, don't go anywhere. If you haven't seen this video about the Federal Reserve, I break it down further. Click on it and I will see you there.